And welcome back to the Kudlow Report. I'm Larry Kudlow. So, stocks retreat today after a three-day winning streak. But listen to this. Since early October, the S&P 1200 Global Stock Index up 21%. In the U.S., the S&P is up 24%. So I want to know if these rallies are going to continue. Let's do some stock market work. We've got Pippa Malmgren, president and founder of Principalis Asset Management, and Russ Koesterich, global chief investment strategist of BlackRock iShares Group. So, Pippa, things have gone swimmingly now. It's been a bunch of months. It's a global stock market boom. I want to know if it can continue, and I want to know if it's signaling a global economic improvement.
Well, bottom line is if you throw this much cash around, if you have all of the major industrialized economies in the world plus China printing money at this rate, then yeah, it goes into asset prices, and we're seeing asset prices rise really fast. I think it's important that not only are stocks going up, but the oil price is going up, and the price of diamonds, as you just reported, is going up. So these are all assets that reflect there's a lot of money in the system, and that's precisely what the policymakers wanted. When central banks print money, the signal is go speculate.
All right, go speculate. Russ Koesterich, I want to get your take on the very same question, and I want to add to Pippa's central bank pump priming and cash putting into the system. Profits are rising. I mean, profits are the mother's milk of stocks. Profits have performed better than GDPs. So, Russ, can this global rally continue?
Well, I think it can. And I add another thing. I agree with everything that was just said. It's not so much that all of the world's problems have been solved, but really you had a lot of bad news discount into stocks back in October. Globally, stocks are trading at 10 times earnings in an environment where interest rates were 2%. That is a very cheap discount for stocks. And what you've seen is that to the extent the world has not fallen off a cliff, investors have reacted. Now, I also agree with the point, if you're going to print money, if you're going to open the monetary spigots, this is going to, at least in the near term, help risky assets. And it's been particularly effective this time because it's also been a backdoor form of quantitative easing by which the European Central Bank has removed one of the biggest pressures, the fear of a banking crisis in Europe and the fear of a near-term sovereign debt crisis in Europe, which is a lot lower today than it was back in October.
And more is coming next week, Russ. The ECB is going to have more short-term emergency loans, more pump priming, to Pippa's thought. So, Pippa, let me ask you this. Whether it's inflation or excess money, or whether it's Iran in the Straits of Hormuz, is energy the place to be? Is the game changing? Get out of consumer discretionary. Maybe get out of technology. Maybe get out of utilities. Is it energy now and maybe a little commodity action on the side?
I think you got to be really careful about the directional play because there's so much volatility around this whole subject of oil. On the one hand, the Chinese economy is clearly weakening, and a lot of people in the market expect that the decline in demand should make the oil price fall. They're also looking at weakening numbers out of Germany, weakening numbers out of Europe in general, and a lot of people don't have faith in the recovery story in the United States because it's still so nascent. On the other hand, I think we're seeing, for example, the Saudis are saying, if we're going to maintain a stable population, we got to buy the peace, we got to write checks for like $5,000 a person. That means we need the oil price above 110. So I think their incentive is to keep it high. Add to that the noise out of Iran, which is loud. And add further, Nigeria is starting to implode in the same way that Tunisia and the Middle East did. That's 10% of America's oil supply. So I think it's going to be really volatile, but net, I'm expecting the price over time to remain high or go higher from here. But I also expect to withstand a lot of downside risk in that view.
Well, I don't know. I mean, all right, Russ Koesterich, seriously, how much downside is there to the energy story? I mean, do you think we're going to wake up and oil is going to drop 10, 15 bucks, or do you think it's likelier we're going to wake up and oil is going to go up 10 to 15 bucks?
I think it's more the latter. I mean, certainly, I think it's hard for any of us to predict what's going to happen with Iran and the Straits of Hormuz. But even if you remove that, if you remove some of this near-term risk premium, there's an important thing to remember about the energy market. It's not just the demand side. It's not just rising demand from development in emerging markets. What's also happening is more and more of the world's marginal supply is coming from unconventional hydrocarbons that are expensive to produce. If you're going to get a barrel of oil out of 35,000 feet of water in Brazil, or out of the tar sands in Canada. What it means is that barrel is very expensive to produce. It's not economical at 60 or 70 a barrel. And I agree that this will probably keep some floor underneath energy prices over the long term.
And Pippa, I'm going to leave it to you for the last here. If energy prices are a lot likelier to go up than go down, if these central banks, including the Federal Reserve and the ECB and the Bank of China, are a lot likely to pump and print, then wouldn't you want an inflation play? I'm trying to sneak commodities in here. Maybe a little gold action, maybe some silver action, maybe some copper action. I gotta like the commodity play right in here, don't I?
Yeah, I am in agreement with that. I even like diamonds as an alternative to gold, as an example. And I think it's look, everybody out of the Middle East and Asia is buying diamonds like crazy as a store of value. That's why they're reaching record prices at every auction. But I also think we should not forget about manufacturing, which has traditionally been a really strong inflation hedge throughout history. And in fact, I think we're seeing a revival of manufacturing in the West. It's moving from China west. Manufacturing is coming home partly because of the wage rises in China, where it's 70% annualized for skilled workers and 30% for unskilled. So the whole wage differential is narrowing, and that is changing the location of production. So I think, yeah, personally, I think inflation is a real issue. I'm not saying there is no deflation around, so that means I'm saying stagflation is still on the table as a risk, but yeah, I'm seeing lots of ways in which one can capture the inflation pressures that are very real.
And that spells whether it's diamonds or gold or silver or commodities or energy, there's an investment strategy right there. Pippa Malmgren, thank you. Russ Koesterich, great to see you again.